All right, ladies and gentlemen, welcome. This is Fausto Puglisi from Cybertrain University. I'd like to thank all of you for joining on Closing Bell. We have a new guest, and I had the pleasure of meeting with him at the New York Stock Exchange, Bill Ryan. I'll do a quick little intro in a little bit. First of all, I'd like to talk a little bit about what happened in the market. My God, what a catastrophe, 270 points. Good news is oil's going cheaper, so that's always good news for some of us. Unfortunately, catastrophes make opportunities, and the opportunity is us. So, but once again, this is the beauty about trading the market and coming back. I always tell everybody that 90% of your time in the market, if you're involved in the market, 90% of your time is spent on education. And this is why you're here, to learn and understand why things are happening in the market. How do you benefit from it? Because great traders never stop learning. And that's why we love here at Cybertrain University to bring in great speakers like Bill Ryan, the managing director at the New York Stock Exchange, Apex Options, because a lot of you here I know do trade options, and binary options obviously has been like a big thing that's been going on for a little bit, and I wanted to bring an expert in here because we do a lot of education. I was actually on a panel at the New York Stock Exchange with JJ from Thinkorswim and Bill Ryan. Kind of felt a little, felt a little uneducated as much as how much knowledge and experience between those guys have in the options market. But the thing is, the great thing that I try to do is by learning and understanding stocks, there's ways of you to capitalize in the options market, and that's why you have to learn from the experts, and that's why when you have guys that work on the New York Stock Exchange, they're going to tell you exactly how it is and what you need to know. Because remember, our goal is if you're an educated customer, if you're an educated student, you're going to make more money. And by you making more money, everybody's going to realize that trading is the best job in the world, and that's why we all do it. So I don't want to take too much time. Bill's going to go for about, I don't know, maybe about 45 minutes, maybe a little bit longer, depending on the questions. So feel free. He has got his really great PowerPoint that he's going to go over in great detail. I mean, I listened to him at the New York Stock Exchange. It was a great presentation. Once again, speaking an instructor at the Options Industry Council. I mean, his resume is longer than some that I've ever seen. So can't get a better experience than that. So without further ado, guys, enjoy the presentation. Bill Ryan, the stage is all yours.
Busy day to listen to what I have to say. I don't know if you heard that, but thank you very much, Fausto, and thank you everybody for taking time out of your day to come and listen to what I have to say. So our subject today is binary options, and the New York Stock Exchange is coming out with a new binary option called a binary return derivative, or a BYRD as we call it. So today we'll talk about binaries. We'll give you an introduction, tell you what a finish high and a finish low option is, and we'll tell you a little bit about some strategies you can use with binaries. But before we do that, we have to satisfy the lawyers. So we have our disclaimer up here, which is standard disclaimer. It tells you a few things. And one of the things it tells you is that options are not for everyone. And even though I've been in this business for over 30 years, I do believe that options are not for everyone. But they are a great tool, and everyone should learn how to use options. And if you take the time and effort to learn the options world and learn when to use different strategies, how to use different strategies, you'll be a much better investor. But if you just like to buy and hold, that's great, buy and hold. Don't be in the options world, because options have a finite life, and sooner or later they will go away. But again, it's a great tool. Come on, come learn, get some education, learn how to use them, learn when to use them, and you'll be better off for it, believe me. The other thing we tell you here is that we don't figure taxes, fees, and commissions in any of our examples here, and that's because taxes are different for everybody, fees are different, commissions are different at every brokerage house, and it would be impossible for us to give you examples of all that. So we leave the fees out, we leave the commissions out, and taxes out. But realize when you look at a strategy that commissions and fees and taxes will impact your profitability. So you have to have a firm understanding of what your fees are and how they will impact your P&L for any trade. So let's start. We'll talk about some key concepts here with BYRDs. And the first thing you have to remember is that a BYRD is a binary return derivative, a binary option. It pays $100 or it pays nothing. So it's also known as a cash or nothing option. And our example pays $100 or it pays nothing. We have two flavors of binary return derivatives. We have the finish high, and you can think of a finish high as the equivalent or a similar tool to a call. And you can think of the finish low as a similar tool to the put. Maximum profit potential for a bird is $100. For a long bird is $100 less the premium that you paid. Now remember I said that they have a value of $100. It pays $100 or it pays nothing. And you'll hear me say that probably 100 times during this presentation. And it's very important to remember that. It has a maximum value of $100. And because it has a maximum value of $100, that's, again, the most you can make with a long bird. $100 less the premium that you paid for it. And the maximum profit for a short bird is the premium that you receive when you sell that binary option. Now, the maximum loss for a long bird is the cost of the bird. Now, that's similar to a standard listed call or put option. And the maximum loss for a short bird is $100 per contract, less the premium received. And that's a little different than a standard option. We're going to do a comparison a little further on in the presentation. So birds are European-style, cash-settled, and automatically exercised if in the money at expiration. So let's just take a look at that European style. For anybody that doesn't know that, European-style options can only be exercised or assigned at expiration. All right, so there's no chance of early assignment with a bird. It can only be exercised or assigned at expiration. Long positions have to be paid in full. Short positions require $100 per contract, basically, in the account, because $100 is the maximum value of that binary option. That's your maximum risk on the short side is $100. The settlement, in-the-money settlement, is based on an all-day expiration VWAP of the underlying security. And we're going to go into the VWAP in detail later on. But it's important that you understand that this settles based on a VWAP, not on the underlying stock. So it's a VWAP of all the trades of the underlying stock, not the closing price of the stock. And that VWAP will be disseminated every 15 seconds, at least on every trading day. So birds have a unique symbol. So let's take an example of Apple. Apple's symbol is AAPL. Many of you that traded options years ago remember when we had wrap symbols with the over-the-counter options. And Apple, I think, was AQQ, I think, then. But our binary Apple symbol will be APQ. So we're going to use a separate symbol, and we use that separate symbol because we don't want to mix the standard option and the binary option. So it has its own symbol. The binary option has its own symbol. And when you look at a chain, the C will tell you that that's the finish high option, and the P will tell you that that's the finish low option. And again, the quotes and trades we disseminate over the tape just like a standard option. Okay, so how are they similar? Well, they're going to be exchange listed and traded. They're going to be cleared at OCC. You can buy or sell anytime during the life of the contract. They'll have weekly expirations, dollar strike prices. They'll trade in pennies. Just like a standard option, the long side has to be paid in full. And the multiplier is 100. So just like when you do your options, your regular options, and you do your calculations, if I pay $1 a contract, that's $1 times 100 or $100. The 100 multiplier is the same with the bird. So they're different, again, the European style. Remember, they can't be assigned early. Cash settled, there's no stock changing hands here. It's just cash that goes back and forth. We have automatic exercise. We have different symbols. And the short side, again, is $100 per contract. That's different from the standard options, which have, depending on your broker, a 20 or 30% of the market price of the option type of requirement, or a naked option, which has an unlimited requirement sometimes. These have $100 maximum value per contract. So we don't have an in-the-money amount like we have in a standard option. That's different. You know, if you trade options and you look at call options, you know that the higher the stock goes, the more your call could be worth. That's not true with the binary. The binary has a maximum value of $100 per contract. And again, the in-the-money calculation on expiration is done on an expiration Friday VWAP. So let's talk about the VWAP and the settlement. So a VWAP is a volume-weighted average price, right? And that's a VWAP is found by taking all the trades, or basically taking the value of all the trades that take place in the course of a day. Now, if you look at the table we have on the right-hand side, you can see the shares and the price, and you can see the value of each of those shares. So what we do is we do some math there, and this is just a 7-trade VWAP. And you all know that stocks are going to trade more than 7 trades in a day. This is just an illustration of how you calculate a VWAP. So you take that final value at the end of the day, you divide it by the number of shares, which in our example is 14,100, and you get a VWAP of $24.99. So again, it's the value of all the trades that take place during the course of the day divided by the number of shares that trade that day, and that's how you get the volume-weighted average price. We're going to settle the binaries or BYRDs off of that volume-weighted average price. Now, it's going to be different, most likely be different than the closing price of the underlying stock, and we'll show you an example of that in a couple of slides. And we use a non-standard routing here to ensure that we don't have a pin situation. So a pin is when the strike price and the stock price are exactly the same at expiration, and that causes some headaches for people. Do you exercise? Do you not exercise? Will I be assigned? Maybe I won't be assigned. We took that out of the BYRDs, so there'll be no such thing as a pin. And we use this standard, unique routing here. And I'll give you an example. If we had an option, a VWAP rather, that calculated out 6 places to 29.999999, we would truncate it and we'd display 29.99. Now, if that VWAP calculated out to 25.000000, we would round it up to 25.01. So by rounding it to 25.01, we say that the finish high is going to be in the money. If we truncate at 24.99, we say that the finish low will be in the money. So we don't have a situation where we can finish at the strike price. So either the finish high or the finish low will be in the money at expiration. Now, it's a little difficult to think about the VWAP rather than the underlying stock price, but if you want to trade the binaries, you have to get used to that concept of the VWAP. Now, when we set out to develop these binary options, we weren't looking for a VWAP. We had conversations with different brokerage houses. We had many conversations with the SEC, and we came to the conclusion that having a VWAP that could not be manipulated or be very difficult to manipulate at the end of the day would be best for our customers and for the overall market, because you couldn't just do one little trade to move that option in or out of the money. And that's why we have a VWAP. So again, the in the money, out of the money amount is based on that VWAP. And the example on the screen in front of you says if the VWAP was at 25.01, the finish high BYRD is in the money and the finish low BYRD is out of the money. And if it finishes at 24.99, the finish low BYRD is in the money and the finish high BYRD is out of the money. So you see how that's the call and put kind of thing there, right? At 25.01, the finish high, which is the call, is in the money. If it's a 25 strike, right? 25 strike in a standard option with the stock at 25.01 is in the money. And for the finish low, if it's at 24.99, the finish low BYRD is in the money, just like a put would be in the money. Now here's an example of a VWAP, and we're going to show you how it could be different. The VWAP will be different from the closing price. You know, here's 4 trades, and very hypothetical. You know this isn't going to happen. The opening trade of the day is $24.75. That's 10,000 shares. The high of the day is $27. That's 500 shares. The low of the day is 23 with 5,000 shares. And the closing price that day happens to be $26, and that's 1,000 shares. So we take the value, we divide it by the 16,500 shares, and we get a VWAP of $24.36. And you see the difference there. And again, this is just an illustration with it. If you did a 4-trade VWAP, the VWAP would be $24.36, and the closing price would be $26. And that's quite a big difference in the two. But you have to be aware that that may happen. And if it does happen, you can see where the closing price and the VWAP are different. And in this example here, the 25 strike call would be in the money, and the finish high 25 BYRD would be out of the money, right? With the stock closing at 26, the 25 strike price standard listed call would be in the money, but the BYRD would be out of the money. And if it was at 24.36 VWAP, the 25 strike listed put is out of the money, but the finish low 25 strike BYRD is in the money. So you can see how there could be a difference here with the underlying price and the VWAP, and that's why it's important that when you do binary options that you pay attention to that VWAP. All right, so let's talk about the finish highs. All right, an example here with the VWAP at 25.01 or higher at expiration. The finish high is in the money. If you were long that finish high, you would be paid $100 per contract. If you sold that finish high, you would be debited $100, and the $100 would be taken out of your account. If the VWAP was $24.99 or less, the finish high expires worthless, and if you bought that, you receive nothing per contract. If you sold it, you get to keep that premium. So these options can expire worthless, just like standard options do. And if you're a seller and it expires worthless, you get to keep the premium. If you're a buyer and it expires worthless, you lose the premium that you paid. So standard call, the in-the-money amount is based on the underlying closing price. With the finish high bird, it's based on the all-day VWAP. Your maximum loss for both is what you pay for that option. You can't lose any more than you pay for it. The maximum gain for a standard call is unlimited above break even. The maximum value is $100 per contract for the binary option. Again, $100 per contract, so your maximum gain can only be $100 per contract minus the premium that you paid for it. The break even on the standard call is the strike price plus the premium paid, and we have it called the in-the-money point, or the maximum value point with the binary is the strike price, or the finish high is the strike price plus 1 penny. So we have an example here. It's a little table. If you look up here, you see 25 strike price at expiration, and we're doing a long call comparison versus the binary comparison. And what you can see here in the shaded areas is what you have to look at. With the underlying at 2501 and the VWAP at 2501, which, like I said, isn't going to happen, but they may be close. If the stock was at 2501, you could see that the call would be worth $1, but the bird, the finish high bird, would be worth $100. Right? Again, maximum value of $100 once it goes in the money by a penny. So if you take that shaded area down to $26, you see that it takes till 26 for the standard call to be worth $100, and the binary is worth $100 from 2501 all the way up to 26. But now when you get to 2601, that long call, that standard call, now has a little bit more value. It's worth 101, where the binary is still worth 100. And if you look down at the bottom at $28, the binary is worth $100, and the standard listed call is worth $300. So you can see the big value, the big impact is in that dollar between $25.01 and $26. But now that can work to our advantage, because if we do a little comparison here and we look at the standard call versus the VWAP, you can see if you look at that middle point, that 85.01, and we're going to buy 8 of the finish high birds here. And with the VWAP at 85.01, we make $496. Well, how do we get to $496? Well, each contract is worth $100. That's 800 contracts, and we paid, I can't see what we paid here. Hold on one second. Let me just move this out of my way. We see that we paid $304 for that. So $800 minus $304 gives us a profit of $496. So we made $496 with this binary option when the stock went to 85.01. Now, if you look at the standard option at 85.01, we're still losing $329 because we have to get to break even. We haven't gotten there yet. We don't get to break even until $88.30. So we get to break even a little faster with the binary because we only have to be 1 penny above that strike price. 85.01, we're making our maximum amount of $496. We get to 88.30 with the standard call, we're still at even. We're just at even right there. So from $83 to, let's see, if we go down to $93.27, the binary outperforms the standard listed option. But then when we get to $93.27, you see that the standard listed option now outperforms the binary because we have that unlimited upside. We don't have that $100 of maximum value per contract. So if we look at this, you think, where can I use a binary? Well, the binary worked best in this situation up until about $93 and change is where it's worth. $93.26, I guess, is where it comes in even. But so an option or a stock that we think is going to be in this tight range, maybe the binary works better. Now, if you're very bullish on the stock, you probably don't want to do the binary. You probably want to stick with the standard listed call. Or you could just spend a little bit more money, buy a few more binaries if that works. If you look at our example here, you see that we spent the same amount of money. Basically, we spent $330 for the standard call and $304 for the 8 binaries. So you have to take a look at that and make some adjustments. Maybe I could buy 10 of the binaries, spend a little bit more money, and get a little bit more upside because 10 of the binaries would give me a maximum of $1,000, less whatever the cost of the next 2 options at 38 cents would cost. So I could increase my profit potential there, but I'm spending a little bit more money. So you can see that the binary may work better in certain places than the standard listed option does. So now if we look here at the, well, we just did this long call. Let me hang on a second. My screen is frozen for a second here. Let's see. All right, there we go. Let's look at the short side of these, okay? So the 25 strike at expiration, if you look at the short call, look at the short binary, right? You see that at 25.01, look at the shaded lines again. At 25.01, our short call is a negative $1 value, but our binary at 25.01 is a negative $100 value. And again, that's because the binary has a $100 payout or nothing. There's nothing in the middle. It's $100 or it's nothing. So that's what we have here. And you can see from 25.01 to 26, the short call is doing a little bit better as far as your loss is concerned. You're not losing as much money as you do with the binary. But then you come down to $28, and you see that you lose $300 with the short call and only $100 with the binary. Now, because the binary has a maximum value of $100, you can't lose more than $100 per contract. So it has a defined risk to it. And that's another benefit on the short side, that defined risk. So let's take a look at the 85 strike again. We're looking at the short, you call it at $3.30, and short 8 of the finish high binaries at 38 cents. If this goes to $75, you look at the VWAP and the stock, we see that we make $330 with the call, $304 with the short finish high, and that's because the maximum you can make is what the premium you bring in when you sell it. You can't make any more than that. But look at what happens if the stock goes against us and it goes up in this example. At 85.01, you're losing $329 with the standard call. You're losing $496 with the binary, again, because it gets its maximum value 1 penny in the money. But let's go up. Let's go all the way down to the bottom. If the stock went to 100, you could be losing $1,170 with the standard call, but only $496 with the binary. Again, that's that maximum risk of $100 per contract. All right, so let's talk about the finish lows. So if, in our example, if the VWAP was $24.99 or lower at expiration, the finish low BYRD would be in money if you had the 25 strike, right? You'd have 25 strike, the VWAP is $24.99, you would receive $100 per contract. If you sold that contract, you would be debited $100. If it was at 25.01 at expiration and you bought the 25 finish low BYRD, you get 0 per contract, basically expires worthless. If you sold that contract, you would keep the premium you received when you sold the contract. So a little comparison, the in-the-money amount is based on the closing price for a standard listed put. In-the-money amount, again, for the finish low BYRD is based on the VWAP. Your maximum loss is the purchase price for both. Your maximum gain with a long put, could be substantial depending on the strike price and the premium that you pay. But again, with the binary, your maximum value is $100 per contract, and you get that point when when the strike price is below the expiration. The break even on a put is the strike price minus the premium, and the maximum profit point or the in-the-money point with the finish low, again, it's the strike price this time minus a penny. So it takes a penny to get into the money and get that, get that contract to its maximum of $100. So here's a comparison of the finish lows on the long side. So on the long side, look again at the shaded areas, $24. You see the long put is worth $100, the binary is worth $100. Come down to $24.99. The long put is worth $1. The finish low BYRD is worth $100. So again, 1 penny in the money, you got that maximum value per contract of $100. Go to the top of the screen. The stock goes down to $22. You can see that put value is increasing as the stock drops, but the binary value is never going to be more than $100. So we'll take a look here at a comparison between one long put at $2.25 and 7 of the finish lows at 30 cents. We have a 50 strike price for both, 63 days to expiration. Here's what happens at expiration with the stock at $25. You can see the puts making $2,275. That's great. The stock is going down. Your put's making you money. The binary, you're only making the $490. Again, this time it's $700 minus the $210. The most you're going to make is $490 here. But come down to the bottom of the screen with the stock at 60. So the stock goes against us. We're losing $225. We're only losing $210 with the binary. And again, you can only lose what you pay, what you spend when you buy the binary or the standard listed put. But you could look in here and see what happens as the stock goes down. You look at 42.84. you're making $4.90 with the binary, $4.91 with the long put. $40, you're making $7.75 with the long put, $4.90 again with the binary. You know, and I've said it a million times already, but you have to remember it only has a maximum value of $100 per contract. So if you do these on the sell side, let's sell them and see what happens. You know, if you sell these, look at the stock at $22, the top line. You're losing $300 with the short put. You're only going to lose $100 with the finish low bird. And again, that's the maximum value, $100 per contract. You know, and I've said it several times in here, but you can see by looking at these screens how that works. You know, follow the screen from $24.99 up. You know, up to, you know, going up, it's going lower in prices. And you can see at $24.99, you'd be losing $1 with the standard listed put, but you'd be losing $100 with that binary. And again, that's because the binary goes in the money when it's 1 penny through the strike price. So you hit that point faster, and that point doesn't change. Whereas with the standards, you hit the point a little later, and it has it's a varying amount. So here's a short comparison with the 50 strike. You're short 1 put at $2.25, and you're short 7 of the finished lows at 30 cents. You know, if you start at the bottom at $60, you can see that $2.25 is the premium we bring in when we sell the standard put, and that's the most we can make, $2.25. And we make $2.10 when we sell the 7 finished lows, and that's the most we can make. But, you know, come up to the top of the screen with the stock at $25. Look at the difference in what we have, what we can lose here. We can lose $22.75 with the standard put. We can only lose $4.90 with the finished low. And again, that's because of that $100 maximum value per contract. That defined risk that, you know, people do spreads to get to find a risk, and that's a defined risk in here. It's $100 per contract. Now, you can think, before we get into some strategies, you can think of the binary options as, you know, 1-point vertical spreads if you do spreads. Think of it as just a 1-point vertical spread. And you heard me say that people do spreads to reduce risk. There are a lot of customers that will do credit spreads, you know, and they sell an option, they buy another option, either above or low, depending on if it's a call or put, and that's what limits their risk, and that's what they like about that spread, is that limited risk they have when they do those credit spreads. So you can think of the binary as a 1-point vertical spread, if you'd like to think of it that way. So let's take a look at some strategies here. On the speculation side, you know, again, finish high and finish low birds. Maximum profit point for the finish high is 1 penny above the strike price. For the finish low, it's 1 penny below the strike price. Maximum loss is the total cost of the trade. Maximum value per contract is $100. So your maximum profit is $100 minus whatever you paid for that binary. It may be more expensive or cheaper than the standard listed option. These should trade under $1 with the maximum value being 100, so they should trade under $1. So you can either use these as less risk or more leverage. So the finish high, again, based on the all-day expiration Friday VWAP, that's what settlement is based on, $100 maximum per contract if the VWAP is above the strike price. Let's give you an example here. So we're going to buy 8 of the 85 finish high birds for 38 cents per contract. Maximum value is $800 at expiration. So our total investment is, or maximum loss is $304. That's 8 times 100. There's your 100 multiplier. 8 times 100 times 38 cents. That's our maximum loss. Maximum profit is $496. That's the $800 per contract maximum value. $100 per contract, 8 contracts, $800 maximum value minus $304. And we get that maximum profit if the VWAP is above 85, is 8501 or higher at expiration. So here's what the table looks like with the VWAP at expiration. You know, look at it at 80. The bird has no value. You lost $304. You paid $304. You lost $304. It expired worthless. At 83, it's the same thing. At 84.99, it's the same thing. But then it goes to 8501. You can't close at 85. We know that because of the unique rounding that we use. So it goes to 8501, and then bang, all of a sudden we have a profit of $496. So it takes that 2-cent move from 84.99 to, you know, to 8501, and we get a $496 profit. And that profit stays at $496. If you look even up to 95, go to 100, go to 110. It's still only worth, you're only going to make $496, again, because the maximum value per contract is $100. So we have limited risk and we have limited reward here. So with a finish low, we can look at this. The in-the-money amount is based on the Friday VWAP once again. Maximum value of $100 if the VWAP is below the strike price. You know, the maximum profit point is a strike price minus a penny. So this time we'll buy 7 of the 50 birds, the finish low birds, for 30 cents a contract. The maximum value is $700, right? 7 contracts times 100. Total investment or maximum loss is $210. 7 times the multiplier of 100 times 30 cents. Maximum profit potential is $490. That's the 700 maximum value minus 210. And we get that if the VWAP closes at $49.99 or lower. So here's our table again. We're looking at the finished lows now. And if you look at the stock at 65, 60, 55, you see we're going to lose the $210. These finished low birds will have no value. We'll lose what we paid for them. But get to $49.99. That VWAP closes at $49.99, and bang, there we are again. We're making $490. Now you see this compared to a standard option. There's no increments here. We're not making $1, $2, $5, $10. We go from a loss of $210 to a gain of $490. And you notice again that the $490 does not change. That's our maximum value, and it would be the maximum value even if this went to 0. So let's look at selling some birds for income here. Remember, the maximum loss is $100 per contract less any premium received on the sell side. We have no risk of buying stock in a declining market and no risk of selling stock short in an up market. So if you think about this, you're called away if you have a call. You're selling stock that you own, or you're selling stock that you don't own. You're naked. You're selling stock now. You have unlimited risk. You know, if you sell a put short and you end up being put, you end up buying stock in the declining market. You know, and sometimes we sell puts to buy stock, and that's fine. Sometimes we're selling to generate income, and we don't want to sell that stock short. We have no risk here. This is a cash-settled product, so there's no risk of either buying or selling stock here. So with the finish high at expiration, you keep the proceeds if the bird finishes out of the money, and if it's in the money at expiration, you debited the $100. That's pretty simple. Again, settlement is based on an all-day expiration Friday VWAP, and I know I said the word VWAP about 1,000,000 times here, but I can't stress enough that you pay attention to the VWAP, not the underlying stock here. So the maximum loss is $100 less the premium per contract. We know that. With a finished low bird, you keep the proceeds if it finishes out of the money. Again, if you sell the bird short and it ends up in the money, you debited $100 a contract. With the finished low, the settlement is based on the VWAP. Maximum gain, again, is the total premium received. And that maximum gain is when the stock is above the strike price here. So let's take a look at an example of a short 25 bird settlement. We can look at both the finish high and the finish low here. And we're going to look at a 25 strike with the stock. Let's say go to the top at $10. That 25 strike bird would have no value. But the finished low bird would have no value, but you would be called away, or you'd have to deliver $100 because you sold that bird short. So you would have to deliver $100 there. If you look at $24.99, the finish high has no value. The finish low, again, it's $100, 1 penny in the money. You have to deliver if you sell the finish low. At 30, we're still losing $100 with the finish high, but the finish low now has no value. So you have no value there. So if you look at this, you see that you can lose only $100 again. And on the finish high side, as the stock goes up, you're short from 25.01 to wherever. You only lose 100. With the finish low, if you're short from our example here, 25.01 down to 0, you only lose 100. And again, that's because the defined risk here, maximum value of $100. So let's look at this a different way. Let's say we need to generate some income, and we figure we have $1,000 that we want to risk to generate that income. So we can look at a binary option, and we'll look at the 25 strike bird here selling at 38 cents a contract. So we say it's $100 maximum value minus the 38 cents. That means I could lose 62 cents or $62 per contract. So if I divide 1,000 by 62, that gives me 16 contracts. I sell 16 of the birds at 38 cents. That brings in $608. If assigned, I have to deliver 100 times 16 or $1,600 is taken out of my account. 1,600 minus 608, my maximum loss is 992. So I have a way of saying I have a defined risk of $1,000, and I'm going to look at this and say I'll risk $1,000, and the most I can make here is 608. So let's take a look. We're looking at the finish high bird here. If you look at the shaded lines, 2501. You see that's where the VWAP kicks. It's in the money. Your debit kicks in. You debited $1,600. You lose 992. But at 25 or 24.99, you see you keep the 608. So if it goes down, the most you make here is 608, which is the same thing as selling a call. The most you can make is the premium you bring in. But our risk is defined. As it goes higher, it doesn't matter to us. The most we can lose in our example is 992. So we have the ability here to generate income with a defined risk. And if you remember what I said before, it's kind of like doing the one-point vertical spread. You know that what that risk is. So you have a maximum amount that you can make, and you have a defined risk. And this is the same thing. We have a defined risk here. And here's what the finished low looks like if we did the same exact thing. You see if the stock went down to 15, we'd lose 992. The stock could go to 0, we'd only lose the 992. We wouldn't lose any more than that. Again, defined risk. And again, most will make is the 608 here. If the stock went to $35, it's the finished lows out of the money. We keep the $608. Same as selling a put short. The most we can make is that premium we bring in. But again, we have a defined risk. We can't lose any more. If we're short a standard put, the stock can go to 0. We're going to buy stock at our strike price here of 25. It can go to 0. Here, we have a defined risk again, $100 per contract, or in this example, it's $992. So let's sum up a little bit here, and then I think if I can open this up a little bit, we can see if we have time for questions here. So the thing to remember most about the binary options is that they are similar and different from standard listed options. We have that known maximum value and limited risk. Maximum value of $100 per contract. The long side risk is identifiable. It's very simple. It's what you pay. The short side risk is equally as simple. It's $100 minus whatever premium you brought in. So defined risk, defined reward. These are European-style cash-settled options. Again, you cannot be assigned early. No stock involved. One of the most important things, settlement is based on the VWAP. Remember that unique symbol. If you're going to trade the birds and you're going to track these, you have to look at that symbol that's associated with the binary option. Looking at Apple, AAPL might give you an indication. You might be able to think where the VWAP is going to go, but you have to pay attention to that VWAP. That's the part that you really have to pay attention to, especially at expiration, because settlement is based on that number, not based on the underlying stock, based on the VWAP number. We can use birds for hedging, income, and speculation. We didn't show you a hedging example here. We had some time restraints here, but you can use birds to hedge. And very simply, it is a dollar hedge. Instead of buying stock and hedging your short call, you're buying another binary option to hedge your short call. You can hedge binaries with binaries. A beautiful thing about binaries and their income generation is the limited risk. And if you do a straddle, anybody likes to do straddles, you sell a straddle with a binary option, one of the two is going to be in the money at expiration. So if you can sell a finish high and a finish low for over $1 over a period of time, now you won't be able to do it that first day, but if you can do it over a period of time, and we have 5 weeks of expiration, you can sell that over $1. You will make money because one of them will be in the money at expiration. You'll be called away, but you brought in over $1. Similarly with speculation, if you buy the straddle, you buy the 25 call finish high and the 25 finish low, over a period of time for under $1, one of them will be in the money at expiration. Remember, we have that unique rounding that says it will not pin to the strike price. So you can have some income and some speculation there as well. So this is what the lawyers make us put up at the end. So it's basically everything we went through here. Remember that the European style automatically exercised, maximum value of $100 per contract. I think I said that more than a few times today. Exercises based on the VWAP. Very important that you remember that VWAP. And finally, the last bullet point, understand the risk-reward profiles and the settlement process of birds before entering into any bird transaction. And that certainly holds true with any option transaction that you get into. So I'm looking to find out where I can open this screen here and see if we have any questions. Let me see. Let me open the screen. Okay. I don't know if Fausto, if you're on, or Jess, if anybody's on there. I don't see any questions that come up. If there are any questions, if you guys could forward them to me, I'd be happy to answer them. Anybody listening, do you have the ability to type in a question? If you have an ability to type in a question, type one in, and I'll see if I can answer it for you. All right, well, I don't see any questions. Let's give it another minute. All right, I guess that's the end of our presentation. I hope you all enjoyed it. If you'd like more information on binary options, you can go to our website. It's www.nysc.com/birds. Again, that's www.nysc.com/birds. Or you can email me. My email is bryan@nysc.com. Again, that's bryan@nysc.com. I travel a lot for work, so it may be, you may be delayed if I'm out of the office and getting the answer. But feel free to shoot me any questions you might have, or go to our website. And once again, thank you all for joining. I hope it was informative, and I hope you get to trade birds. Again, they don't trade just yet, but we hope to begin trading them soon. Go to your broker, ask your broker if he plans on supporting birds, and then you'll have an answer if you can trade them or not. Thank you once again. I'm going to end the presentation. Everybody have a good evening. Thank you.
Sorry about that. I lost my audio really quick. First of all, thanks a lot, Bill, for coming. I hope everybody enjoyed the presentation. And for everybody, welcome to coming back for a closing bell. And we look forward to seeing you next Tuesday. So for everyone else, I look forward to seeing you in the cyber group room. Whoever's a member, if not, give us a call, find out a little bit more about it. And remember, I am going to be doing a live trading demonstration of the stock market during the market hours, so feel free to come and join us then also. Guys, thanks very much, and enjoy the rest of your evening.